Note in the Dow that the candlestick signals pretty clearly illustrate what's happening at important technical levels. An evening star signal at the 50-day moving average, a gap up doji followed by an evening star setup right at the 50-day moving average. That made it fairly relevant, or not relevant, but illustrative, that the 50-day moving average was acting as a resistance level. Then the simple analysis of a candlestick sell signal and a close below the T line kept you in a downtrend until you saw a candlestick buy signal and a close above the T line. Support level, buy signal, another sell signal, close below the T line. What happened back here at the support level? Well, there was the possibility of a hammer signal being confirmed, which it didn't do the next day. Notice that it opened here and closed here. Where did it open? Right at the resistance level of the T line. What happened over the next couple days? They couldn't get back up through the T line. When they gapped down on Friday, after a doji, which is your bearish best friend, what did it tell us about the support at the support level? It wasn't there anymore. Today, as we woke up after a big selling day that broke the support level on Friday, the pre-market indication was they're opening lower. That told us there was not any buying obviously coming in. And what's that put us into? There's a wave 1, there's a sideways channel, there's a wave 3 to the downside. Just knowing that this was opening lower allowed candlestick investors to take advantage of sell signals that would be enhanced by the market still continuing down. Shopify, SHOP, was an illustration of that. Doji, gap down on Friday, your bearish best friend. They opened lower today, continuing down. Now, because of the graphics of candlestick analysis, there's likely targets that these prices can move to, which here's a case where it might be obviously this level. So you're shorting or buying puts here with the probabilities in your favor that you're still heading down, stochastics heading down, so you're not in the oversold area, they're still selling off. That simple 2 plus 2 type analysis you can also attribute to the selling in Wayfair, W. Notice the 50-day moving average was pretty much telling you the sellers were taking control, and then they opened it lower today, telling us they're below the T line and they're still trading lower. What was the expectation of today's trading? Well, if that was candle 1 of a bearish doji sandwich, the magnitude of this candle was at least this level if you started shorting immediately. And this is the benefit of candlestick analysis. Because we know what the signals are going to represent or produce, that we knew that as soon as this opened lower after a little inverted hammer type signal and stochastics heading down, the probabilities were pretty good that they were selling this one off or continuing to sell this off. You were in the right position at the right time. Do you have any idea of whether the magnitude of the selling was here, 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 or here? No. You just know that you're in the right position at the right time, and you get the benefit of being in the right position at the right time when the selling becomes very hard after you've shorted a position. This is not rocket science. Candlestick analysis is merely the graphic depiction of what occurs in human nature time after time. That'll be it. We'll see you in the chat rooms.